Hi, John Dobis from Forbes here at the San Francisco Money Show with Mike Khouw. He is the founder, right, and chief investment officer and guru?
The chief strategist is my title.
Chief strategist of TradeLinks. You deal a lot in artificial intelligence trading, and if you watch CNBC at all, you might see this guy on what's it? Options Action.
Yeah, every week for the last 9 years.
So you talk a lot about options, and you go, and people go, wow, he was smart. But what you're actually talking about there, let's try to give people a sense of how to get into the options. And I love options. I like to sell them. You're talking about covered calls. What's a covered call, and maybe, how do you choose the right stock and the right expiration, and how do you know if you're getting enough premium to make the trade worthwhile?
So, it's very interesting. Options can be kind of intimidating, I think, for first-time participants in that market. But it's interesting because it is a form of insurance, and insurers typically like to get a little bit of premium, make some money for selling their product. What actually ends up happening is that most options have that premium in them. They tend to be a little bit overpriced. So all else equal, if you're thinking, I'd like to get involved in the world of options, how do I get started? If you want to improve your odds of success, the first thing you should think about doing is selling covered calls on stocks that you already own, like, and hold. Chances are that the calls you sell are going to expire out of the money. You're going to collect that additional premium.
And do it again and again.
And you can do this again and again. And you're asking the question, what expiration? Well, we've done extensive research as part of what we do on which options are overpriced, which are underpriced, and which are fairly priced. You don't find underpriced options very often, which is one of the reasons why, if you just had to guess, selling them is probably the way to start. But the other thing is that the options that are overpriced are typically 4 months and in. When you start looking at longer dated options, it becomes a lot of things can happen over the longer term. But in the short term, stocks tend not to move a great deal.
Right.
And so collecting this additional premium, options also decay much more rapidly if they have little time to expiration. So that sweet spot is probably, if you're going to sell covered calls, 30 to 45 days. We even like sometimes if people are not inclined to do something as regularly, they can even go out 3 months or a little bit more.
Right.
But this is the first strategy you should be involved in, has a high probability of success, can generate additional income. Oftentimes, if you sell a call at a strike where you'd already be willing to have the stock called away from you, would be willing to sell it, then basically you're being paid for the possibility to do something you already wanted.
Right.
When you sell puts, cash-covered puts, you're basically selling somebody else the right to sell you the stock at a price lower than it currently is. And if it's a stock you already wanted to own and were willing to buy at that price, you're getting paid for the privilege, essentially, that you might actually have it put to you.
And really the same risk profile as a covered call, right? Or a buy right.
That's right.
Capped upside and substantial but not total downside.
Yeah, that's exactly right. I mean, these are selling cash covered puts and selling covered calls are not trading strategies, they're investment strategies.
Right.
And they have a risk return profile that is somewhere between that of buying bonds and buying stock outright. You don't have all the unlimited upside you have when you buy a stock, but you are generating additional income. So you have capped upside like you do when you buy a bond, but you have some. But you have higher income. So you're basically trying to, thread the needle between them.
Is there a certain amount of annualized return premium that you should be looking for? I think the number of 15%, it seems pretty good. Like if you're going to sell, if you have a $50 stock, you want to get at least
1% a month, and then % a little bit of appreciation.
1.5, 1.2, yeah, exactly.
So a lot of people will look to sell calls that are just very slightly out of the money, maybe 30 days out, 2-3% out of the money. And if you could monetize that by collecting 1% a month in premium, then you're looking at annualized rates of return that are going to likely be somewhere in the neighborhood of 12 to 15%. We live in a low volatility environment, and in low volatility environments, you expect to make less for the risk you take, and that's actually true right now. Options premiums are a little bit lower. But I think that's a good way to think about it. How much do you expect to make if you buy stocks in general?
Hey, 15% a year would be great, wouldn't it?
Yeah, and that's actually above average. And one of the things about strategies like this is that it has been proven by research that over time, the risk-adjusted rates of return tend to be higher. You will not have the long shot years when the market's up huge amounts, but you will generate more consistent returns for sure because you're clipping coupons along the way.
I love hearing that stuff. Good to hear you, Mike.